For 70 years, the world quietly agreed that goods should move wherever they were cheapest. That agreement is now being torn up, one shipping lane, one tariff, one choke point at a time, and the bill is sitting on the shelf at your grocery store. For decades, we lived in an era of globalization that promised efficiency, lower costs, and interconnectedness. Businesses found the cheapest places to manufacture goods, and supply chains stretched across oceans, ensuring consumers from Los Angeles to Lisbon could buy everything from smartphones to sneakers at rock-bottom prices. But this system came with one crucial assumption. The world would stay relatively stable, and countries would cooperate to keep trade flowing freely. For years, it seemed unbreakable. But now, that assumption is starting to crack. The result? A world where the price of everyday things, from groceries to gadgets, is creeping steadily upward, and the global economy is shifting in ways we're only beginning to understand. The first warning sign came in 2018 when the United States and China entered a trade war. Tariffs, which are essentially taxes on imported goods, were imposed on hundreds of billions of dollars worth of each other's products. By 2025, these tariffs reached staggering levels, with the U.S. imposing a peak tariff of 145% on Chinese goods, and China retaliating with a 125% tariff on U.S. goods. These weren't just minor squabbles. They were a declaration that trade was no longer about cost efficiency, but about geopolitics. Then came the pandemic. When COVID-19 hit, global supply chains snapped under the pressure. Factories shut down, shipping rates soared, and critical goods like semiconductors and medical supplies became painfully scarce. At first, governments and businesses treated this as a temporary disruption, a one-time crisis to be weathered. But as the pandemic dragged on, it exposed deeper vulnerabilities in the system. Suddenly, countries and corporations weren't just asking themselves how to make goods cheaply. They were asking how to make them safely, without being at the mercy of a far-off supplier or a distant port. And just as the world started recovering, Russia invaded Ukraine in 2022. The conflict sent shockwaves through Europe, disrupting energy supplies and food exports. Ukraine, known as the breadbasket of Europe, saw its wheat exports plummet, leading to food shortages and price spikes in countries thousands of miles away. Meanwhile, sanctions on Russia forced European nations to scramble for alternative energy sources, rewriting the map of global trade routes. The message was clear. Trust and stability in the global system could no longer be taken for granted. One of the most striking examples of this shift can be found in the Red Sea, one of the world's busiest shipping lanes. For decades, it served as a vital shortcut between Asia and Europe, with countless container ships passing through the Bab el-Mandeb Strait every day. But starting in 2023, it became a danger zone. Houthi attacks on commercial shipping turned the Red Sea into a no-go area for many carriers. By 2026, traffic through the strait was reduced by half, and major shipping companies began rerouting their vessels around the southern tip of Africa. This detour through the Cape of Good Hope adds thousands of miles and weeks to journeys and costs far more in fuel and time. Meanwhile, the global supply chain began to reorganize itself. Companies started moving production out of China, not just to save on labor costs, but to reduce their exposure to geopolitical risk. This trend, known as decoupling, led to a surge in manufacturing in countries like Vietnam, India, and Mexico. By 2023, Mexico had even overtaken China as the largest trading partner of the United States. At the same time, a new term entered the lexicon: friendshoring. Coined by U.S. Treasury Secretary Janet Yellen, it refers to the idea of moving production to politically aligned countries that pose less geopolitical risk. But the transition away from the old model of globalization hasn't been smooth. The unraveling of global trade has led to a series of cascading consequences. One of the most visible has been the rise in prices. When the cost of moving goods goes up, whether due to tariffs, longer shipping routes, or the need to build factories in higher-cost countries, those costs are passed on to consumers. The price tag on your groceries, electronics, and clothing tells the story of a world where trade is no longer frictionless. And then there are the choke points. These are narrow passages like the Suez Canal and the Straits of Hormuz that serve as bottlenecks for global shipping. When the Ever Given container ship got stuck in the Suez Canal in 2021, it blocked 12% of global trade for 6 days, a stark reminder of how fragile the system is. But today, the stakes are even higher. Choke points are no longer just logistical risks, they're geopolitical flashpoints. In the Red Sea, the Persian Gulf, and even the Arctic, shipping lanes are increasingly shaped by power struggles rather than geography. And when a single incident can disrupt the movement of goods worldwide, the costs ripple through the entire global economy. The era of cheap, frictionless global trade is ending, replaced by a world where geopolitics shapes every aspect of commerce, from contracts to shipping routes. Trade, once the great equalizer, has become a tool of leverage and a source of vulnerability. The shift from cost optimization to risk management is creating a fragmented, multipolar trading system, one where trust and alliances dictate the flow of goods. This new reality will likely reshape how we produce, consume, and compete, with significant implications for businesses and individuals alike. The question is no longer just where to find the cheapest goods, but how to ensure their reliability in a world fraught with uncertainty. If cheap, frictionless trade was the engine of the last 30 years of growth, what kind of economy do we get when that engine stops working the same way? And is anyone actually steering the transition?